Yeah. Good morning, everybody. This is the live market open for Wednesday, February 17th. I'm Yohay Elam of Forex Crunch and Market Movers podcast, doing the show as usual for FX Street. I see quite a few of you in the room. We had a turn in market mood. We're going to talk about that today and, of course, lots of other things. As usual, recent developments, various charts and levels. We had some sterling suffering, to say the least, and the next 24 hours, which feature the most important event of this week. If you cannot see the chat box under the screen, sorry, please go to the address that you can see here, tlk.io/fxread-forex-live-video. Okay, so let's begin as usual in the recent days with the market mood, because that's what matters. Yesterday, the big news of the morning that came, I think half an hour after we finished the show, was that Saudi Arabia and Russia decided to freeze oil production. Now, what does this mean? That means that both countries that are now pumping at record levels, at least we know that about Saudi Arabia, the production is only growing, okay? They decided not to increase their production. They stick it to January 11th levels, okay? But they're still going at full speed. So you can look at this agreement in two ways. Either this is a trust-building first step. Remember, both sides are in. Russia is supporting the Assad regime in Syria. Saudi Arabia is on the other side, wants to topple him. These sides don't trust each other, also not on oil. And this is the first trust-building step. And later we could also have production cuts that will involve other countries as well. Or you can see it as too little, too late. It's not a production cut. And in any case, these countries are not going to respect the agreement. And of course, you need other countries to come on board, like Iran, Iraq, and the US shale industry, of course. Okay, so let's start. Why am I talking so much about oil at the very beginning of the show? That's because oil makes markets mood. When oil is rising, then market mood is better. And when oil is falling, the market mood is worse and the safe haven currencies are in demand. So this is what we had yesterday in WTI crude oil. When we first heard the news, oil prices, WTI, jumped all the way to almost 31.50, and then but it immediately fell down. Okay, markets didn't believe it. The rest of the day, oil prices continued sliding and they began falling again. Okay, I just answered a quick question from Jax. There is an ECB non-monetary meeting today. I don't think you should worry because usually we don't get headlines out of it. Okay, so it's not. It used to be a very big deal around the Greek crisis, but now it isn't that important. It isn't expected to result in any headlines, at least not market-moving headlines. Okay. Anyway, it was the big news of yesterday that we had this first agreement actually between Russia and Saudi Arabia, which is a big deal, but not good enough, and oil prices continued falling. And that changed the market mood, okay? Stocks were not so happy compared to the previous 3 days, okay? We had the US stock market sort of looking for a new direction. We had Asian markets sliding, okay? In addition, during the night, another thing that impacts the mood, China slightly devalued the yuan. Okay, once again, this causes worries about capital outflows from China, about the stability of the Chinese economy, about Chinese demand for everything, not only commodities, but everything else. Another anecdote is that Buffett probably, Warren Buffett sees a bottom in oil prices, and he invested in an oil pipe operator. Okay, that's just a small anecdote. But let's look at the chart before we talk about other events we had yesterday. So this is oil. Euro-dollar got stuck yesterday, okay? After it, this is the Draghi-related fall. It fell all the way to 111.20. Yesterday we had it rise towards 112 and then slide once again. This morning, with the worsening of the mood, especially in Asia, we're seeing Euro-dollar rise, okay? The euro is a safe haven. It enjoys a worse mood in markets. Yesterday, when the mood did worsen just a bit, the euro got a bit stuck. It didn't move too much, okay? I remember that we just had Mario Draghi on Monday afternoon showing his readiness to act, pushing the euro lower, and this still had an impact. But today, this impact of Draghi is beginning to fade away, and the bad mood is back. Bad mood is best reflected in the yen. Okay, so if in the past 3 days we had dollar-yen rising from these very low levels on Friday with the intervention, or Thursday, all the way here, almost 115. Now we're seeing it slide again. Okay, first slide yesterday, a small correction, and then another slide. 113.54 is the current level. Much bigger range right here. And let's try to draw more lines here, although remember, this is a bit dangerous, this currency pair. 113.20 is some kind of support, resistance. I would say still here at 114.25, but it's weak. 115 is stronger resistance. Okay, let's talk about the pound. This is an impressive crash. Okay, and it respects the support levels. Okay, once it fell under 143.65, which worked very nicely for a few days, we had it crash. Why did the pound fall? I don't have it here. And okay, I didn't update the slide. Slightly disappoints the UK inflation report. Okay, what happened in the UK? We had headline inflation coming out as expected, but core inflation, if you remember yesterday, I mentioned to look at core inflation. It came out a bit worse than expected year over year, 1.2 instead of 1.4. At first, we only had a small slide in the pound. Okay, we didn't have a total crash. But later on, we did see a continued deterioration. When US traders came back online after that bank holiday on Monday, after the President's Day, we had a continued deterioration. We fell clearly under 143.65. I see 142.30 as some kind of support. It's not that strong. It's still worth mentioning, 142.30, and we're still above it. So this is the range I see for cable, 142.30 to 143.65. So it had a belated effect, this inflation report, but it certainly worked. Okay, dollar CAD, naturally moving by oil prices. What else can it do? So yesterday, when we initially had the news, we had this false break under 137.20, reached almost 137, but that was very, very short-lived because oil prices began deteriorating. We've seen 139.10 resistance work very nicely here in CAD. More developments on oil prices are expected today. Okay, Aussie dollar, a worse mood in Asia, especially in China, but it began already yesterday. So we're back to the lower range in Aussie dollar, back under 71.40. Currently not going too low, finding here some support at 70.80. Okay, not sure it's that strong, but anyway, the Aussie dollar is impacted by the mood. Okay, Kiwi dollar, also it got hit by a fourth consecutive fall in milk prices in the global dairy trade. We had a fall to a fall of, what was it, 2 point something percent. Anyway, it's the fourth consecutive fall. It wasn't such a big fall in comparison to the previous one of 7.4, but it's still dampening. It adds to the negative atmosphere. Why? Because beforehand we had three negative events impacting the Kiwi. We had inflation expectations falling to the lowest levels since 1994. We had retail sales falling short of expectations at 1.2, and we had the Prime Minister in New Zealand, John Key, saying that he had expected a bigger fall in the price, in the value of the Kiwi, if you look at milk prices. Okay. Anyway, we did fall yesterday under this line of 65.80, which is long holding support, and yeah, almost 65.40. Now we're seeing some kind of a recovery, some kind of an attempt to retake this line. Let's see how things develop. Dollar Swiss, very, very much in a range right here, 98.50 to 99. Boring pair. Euro Swiss maintaining its holding up above 110. I suspect this is the S&B's intervention. euro pound, well, the crash of the pound yesterday and the stability and now the rise of the euro, we had a break under the 77.40 line, which was important. Now we're back to the high range, currently 78.25. 78.70 is resistance. Bad atmosphere means a higher euro pound. Euro is a safe haven, pound is risk asset. What's going on in the safe haven pair? Both are safe havens, but now the yen has the upper hand. Euro yen is falling. The yen strengthened a lot against the dollar while the euro was stable. We're under 127. Support here at 126. Sort of leaning lower within the range of the safe haven pair. Pound yen, very exciting pair. Worsening mood yesterday. Bad inflation report from the UK. We're back to 162 after a failed attempt to break above 166. Support is at the very, very round number of 160. As I speak, we're under 162. Okay, and I see we have a question here from Jax about oil. Gas prices at the pump in the US, state of Ohio, jumped 0.30 a gallon from Monday to Tuesday. Yeah, well, I don't follow individual prices. We do have some fluctuations. It's never, like in Forex trading, it's never a one-way street. So, but in general, the trend in US gas prices at the pump are, well, they're heading south. So maybe there is, well, some stability, some bounce. They aren't, I don't know, they're not updated minute by minute according to what's going on in markets. In general, the trend is down, and this leaves more money in the pockets of American consumers. What they do with this extra money, and they don't spend it too much, at least, well, in January, finally, they began spending it. That's a different story. But what I'm talking about is, I mean, prices at the pump move more slowly than prices of the futures markets, okay? In any case, we're seeing the general trend in oil is to the downside. We're above the lows of $26 we've seen yesterday on WTI crude oil, and also Brent oil is above $30, a more relevant price for European markets, but in general, we're not, this is still not going anywhere fast, okay? Let's see what other events we had yesterday. Sorry for not updating this. German zoo indicator came out at 1 point, a bit better than expected. It was expected to fall to a flat 0. Okay, so this was not too shabby. It had a little impact. Next week we have IFO, which is more exciting. Okay, what else do we have on our agenda? The US Empire State Index, it came out a bit worse than expected, but as I mentioned yesterday, a weak manufacturing sector in the United States, in general in the developed world, is not a big surprise. What do we have today on the agenda? I'm sure I put this. Okay, regarding oil prices, let's start with that. It's not here on the agenda, but today we have a meeting between Iran and Iraq, okay? These two countries that fought a terrible war in the 1980s are now close to each other because there's a Shiite government in Iraq. They're more friendly with Iran. Iran is also more friendly with the world. Anyway, Iraq is also pumping out at full production above 4 million barrels a day. And they have sort of said that they're ready to cut production as well. Sorry, not cut, but freeze production, go along with the Saudis and the Russians. That's significant. But the wild card is Iran. Iran just came back online from all the sanctions, and they need the cash, and their oil production is very cheap. So they want to pump out as much oil as possible because they make money. Okay, they have a net revenue, their hard currency that their economy needs, and of course they need. And of course, they make a big profit because it's cheap to take oil out of the ground. Why should they cut production after just coming back online? They might say, okay, we agree to a freeze, but once we reach pre-sanction levels, or they might just pay lip service. Yes, we agree to a freeze, and actually pump out a lot of oil. So can the Russians. The Russians did that in the past. So, but let's see what headlines come out of this meeting. I don't have a specific hour for that, and of course I don't know when it's going to finish, but watch out for news from this Iran-Iraq meeting on oil. Now let's talk about other normal indicators we have on markets. At 9:30, we have the UK jobs report, very important for the pound, especially as it's down. Let's begin from the most important figure, average hourly earnings, okay, including bonuses, the wider figure, okay? It fell to an annual level of 2% last month, okay? Well, 3 months year over year. Anyway, this time it's expected to tick down a bit more, 1.9. Wages, that was the strong point in the UK economy, but that, as Mark Carney said, this rise in wages began flattening. Okay, so now we're expecting another flattening or another small downfall. It already reached 3%. That's the most important thing, because it eventually this results in inflation. Okay. Also, and this is the figure for December. Okay, the last one for 2015. Also worth mentioning is the one excluding bonuses, expected to also take down from 1.9 to 1.8. In the past, what used to be important is the claimant. Okay, this is the amount of jobless claims, and this is a fresh figure for January. Last time we had quite a good figure, a drop of 4,300 in the number of unemployed. This time we're expecting, well, more of the same, 3,000 less unemployed, okay? I would say that's second tier. And the one that is the most important, most important politically, but has less impact on markets, is the unemployment rate. It's expected to fall from 5.1 to 5%. All in all, similar picture in the US and in the UK. More jobs, but the pay is not rising really fast. In the UK, we already had an improvement, but then we had another deterioration, okay? In the US, we're still seeing a positive trend. All right, so what do we have afterwards? Well, moving to the United States of America, we have a very, very busy day. We have at 1:30, lots of figures coming out. Okay, this is a mix, okay? We have housing starts and building permits. Housing starts are expected to rise just a bit, as you can see here, from almost 1.15 to 1.17, while building permits are expected to slide, well, just a bit. If both figures come out better than expected, it's good for the dollar. If both come worse than expected, it's bad for the dollar. What we have in many, many, many cases is that they come, one beats and the other misses, and that just causes confusion. If this happens, we can ignore everything. Another figure is the producer price index. Of course, it's negative mostly because of oil prices. This time we're expecting the moderation. Base effects like in CPI are going away. I mean, the big fall in oil prices seen last year. So it's year over year for January. After a fall of 1% in December, we're expecting 0.6. Also worth mentioning is the, well, that's month over month. I would say year over year would be more important. Anyway, these releases are not as important as the CPI. It's just sort of a warm up, and it comes out at the same time as the housing data. So it's quite a mix. All right. Anyway, the core prices are expected to rise from 0.3 to 0.4. In the previous months, we had better than expected PPI reads. Again, if PPI and housing starts all go in one direction, it could have an impact. If they go the other direction, it could have an impact. But if they go everywhere, I mean, if one beats, one misses, another comes out as expected, it's just choppiness all around, okay? 45 minutes afterwards at 2:15 p.m. GMT, we have industrial output. It's more important in the UK and China, even in the Eurozone, than in the US. And it's going to be disappointing because that's what we know from the manufacturing sector. These are figures for January. Month over month, we had a drop in December of 0.4. This time, plus 0.4 is expected, but I wouldn't be surprised if it disappoints. Another figure around this is the capacity utilization rate, which also deteriorated in recent months with the fall in the manufacturing sector, and no big moves are expected. But all these, well, PPI works as a warm-up for the CPI, and the figures in general work as a warm-up for what we have at 7 GMT, the Fed meeting minutes. Big event, could be a snooze fest as well. The Fed releases a very long and detailed document about what members talked about in the recent meeting. The recent meeting was held in January 27th. Almost 3 weeks have passed, or 3 weeks exactly. Since then, we had a lot of developments. But let's go back to that meeting. In that meeting, the Fed again expressed sort of optimism about employment, but worries again about inflation, just like in the December meeting. In December, they decided to raise rates. In January, they decided to pause. It was no surprise. It was perhaps a bit more hawkish than expected. And no, it was sort of balanced. This time we'll get the minutes. These could reveal how many members are leaning to the hawkish side, how many are leaning to the dovish side. They did mention in that meeting global developments. Since then, as we know, we had more turmoil in markets. So in the past few days, things have improved a bit, but not so much. What can we expect? One thing I want to remind everybody. On one hand, the document is considered stale because since that January meeting, we had the non-farm payrolls, which showed a higher rise in wages, good retail sales, in general, relatively more positive data than we had. I mean, not that serious of terrible figures. On the other hand, we had lots of turbulence in markets. Okay, so you can say, okay, this document is not so relevant. On the other hand, it's important to remember that the document is revised until the very last moment, until maybe yesterday or today, underwent revisions. Okay, so the Fed, of course, knows that this document, the Fed meeting minutes, has an impact on markets and edits it to reflect what it wants to say. So it's not exactly what we had in that meeting, sort of a raw documentation, but a document that is supposed to move markets in one direction. What do they want to do? They want to maintain a balanced approach. On one hand, to say the U.S. economy is doing well, we're confident. We didn't make a mistake back in December, and we leave the door open for raising rates. We're not going to tell you when, but don't worry, we have your back. We're not going to shock the economy, and probably not in March. Okay, that's going to be the message. If it comes out better, more hawkish than expected, and I suspect that they still want to show confidence, and a few figures have been indeed quite positive, I think this will have a bad effect on markets. So if we have a hawkish Fed, if we have the Fed being more sort of optimistic about the economy, and which is supposed to be a good thing, but anyway, still leaving the door open for raising rates in 2016, and bond markets don't expect that at all, then we could have, I believe, a bad reaction for markets. That means a stronger euro, a stronger yen, unsafe haven flows, and weaker commodity currencies, a weaker pound. If we have the Fed trying to giving markets all the possible support, more than Yellen did last week, then we could have the other effect. We could have rising stock markets, rising oil, falling euro, falling yen, and stronger commodity currencies. I believe they'll try to keep it balanced. Remember, we had rate decision is more important. Yellen's testimony, when you hear her voice, it's more important. So the Fed, of course, is the biggest player in markets, but this is not the most important document. It's going to be a boring document. Market reaction could be a bit slow at the beginning, but I still believe we can have an impact once many analysts decide what's been written there. Okay, if we see more positive stuff about employment, or we see more negative stuff about China, about commodities. So it's going to be interesting. I don't have a bias. I do have a bit of bias. I think it'll be a bit more hawkish than expected, adding to the negative mood in markets, helping the euro and the yen. But I'm really not convinced. I mean, I'm not fully certain that that's what we'll have. I see your question. Why should the US be apologetic? Wasn't the world screaming for the Fed to hike? Well, part of the world was screaming for the Fed to hike, but mostly just to do it to get over it, not to end the uncertainty about when the Fed will hike. Okay? And the other parts of the world said that this is a bad timing. The US economy is hardly getting out of, still growing very slowly. China is slowing down, that it's a terrible time to act. I think that they should have acted, because the longer they wait, the bigger the bubbles in equities, in real estate, especially in emerging markets, and they should have done it already. And I think they prepared the markets for quite a long time. So we had the market screaming in both directions. We had the IMF telling the Fed not to hike. We had some emerging markets telling the Fed to hike to get out of this uncertainty. So, of course, Janet Yellen and her colleagues are always under big pressure from all sides. We've seen that also. They're under pressure from US politicians. They grilled her quite a lot in the previous decision, okay, in the previous testimony. Okay, let's talk about more events we have today. Well, that's the main event for today. And then during the night, we have the Australian jobs report. Let's see what we're expecting there. In Australia, we had really excellent stuff. Tomorrow, this is the FX Street calendar on Forex Crunch. The main figure is the employment change. Last time it fell by 1,000. It was expected to fall much more. This time it's expected to rise by 15,000. And the unemployment rate, which was at 5.8, is expected to remain unchanged. It was already at 6.2, 6.3. And these are the main figures. Other figures are, of course, the participation rate, the level of part-time employment against full-time employment. Of course, if we have a big rise, if we have a nice rise in employment, but all of that is part-time, it's not really the same as full-time jobs. Okay. Anyway, for those trading the Aussie, those trading late at night, this is, of course, a very big deal. And we have Chinese inflation data, also has an impact, of course, on the Aussie, but in other places in the world. Note the big difference between the producer price index, which is at, well, terrible levels, a drop of 5.9 year over year. Now we're expecting something a bit better, 5.4. And the consumer price index, which is sort of like in the West, just under 2%, and now it's expected to rise just a bit, okay? Stronger figures mean more activity, and it's better for the world. Earlier this week, we had from China the loan figures, usually something we don't talk about, but these were so outstandingly strong that on one hand, it was sort of it cheered markets. On the other hand, people said, okay, this is not for real. So anyway, we should take Chinese data with a grain of salt always, and specifically around the new year, Chinese New Year, which causes figures to be a bit skewed, to say the least. Okay. Any questions? Any charts you want to talk about? Any other questions? Let's look at a bit the current levels. This is one of my favorite things. The implied probabilities for a rate hike in the United States of America, currently at for March under 5% chance, around 4% chance for rate hike in March. I won't bore you with all the figures, just jump to February next year and a year from now. Also, more chances than not, according to bond markets, for no rate hike, okay, at all. So a rate hike is priced in only somewhere late in 2017. Let's see how this changes after the Fed meeting minutes today. Okay, I have here a question for Aussie yen. Aussie yen is one of the best reflectors of risk on, risk off, okay? So stronger yen, weaker Aussie, that's what happens. We found support. Well, we stayed away from the 80 level. I see support a bit below. Perhaps we can add a few more lines here to get a clearer picture. I think we have another line of resistance right here. Yeah. So this is a nice line. Why 82.45? Because first of all, it worked here as support and then as resistance. Now I think if we continue having a bad mood, let's say the Iran. I see two people ask about Aussie yen. Must be a popular currency pair. So if the Iran-Iraq deal, let's say, goes really well, we could see the pair moving higher. And then I would say resistance is at 82.45. If things go worse, well, that's not the only thing on the agenda, of course, today. If we have a really hawkish meeting minutes and the markets again go for the yen and against the Aussie, well, I think 80 is still kind of support level, just because it's a round number, but much stronger support is at 77.40. Okay. In general, the trend has been, well, it's been quite a roller coaster because of the decision in Japan to set negative rates, and then things turned against the Japanese yen, against the Bank of Japan, and in favor of the Japanese yen. So this is the big roller coaster we had in the pair, but so it's quite messy, but the general trend, as you can see, is to the downside, okay? 77.40, strong support. Strong resistance 88.50, but we have 88.45 before that, okay? But there's a clear divergence. If we have bad data from China, that will surely hurt the Australian dollar and surely support the yen. If we have a good Australian jobs report, well, that impacts only the Aussie. Okay, that's not the mood in markets, but for things to move the pair, it's the Iran-Iraq deal, it's the Fed meeting minutes, it's the Chinese data. Sorry. More questions? Let's take another look at what's going on in the world's most popular currency pair, euro-dollar. Okay, we're a bit off the highs. The highs were 111.80, almost 111.80. Currently 111.66, very much in the range we've seen in recent days. After the big rise and fall, we did see some consolidation, some stabilization in euro-dollar, sorry. In any case, I still see support right here at 110.70. I think it's a very important line. Resistance, well, 112.50, not that strong. I would say maybe perhaps 112 is a bit more relevant at this moment because it worked as resistance yesterday. Okay. Let's take a look at oil prices. Remember, oil prices move markets, even though sometimes the rise in oil prices is related to supply and sometimes to demand. And I think it does make a difference, because if oil prices are falling because of weak demand, that's real trouble, right? Because the world isn't doing enough. But if oil prices fall because of supply, it's not necessarily that bad. at least for consumers. Okay, any more questions? Yeah, we have a question here about are we seeing pound dollar and pound yen at this point? Well, the pound is down. It's vulnerable. Remember, we had earlier this week Ian McCafferty, who used to be a hawk and voted for raising rates. He later changed his mind. He said that the case is less compelling for raising rates. Now, compounded with the inflation report, which was just a tad weaker, the pound remains vulnerable. I don't think it's oversold. The next big thing for the pound, and that also answers your question, Jax, appears to watch today, is about the pound because of the jobs report in the UK. Okay, so this will be a big deal. If wages are positive, and we could have it bounce back to resistance 143.65, and then 144.50. And I would say if we have another big fall in wages, in general in the jobs report, we could have the pair fall to even lower ground under 142.30. Okay, I would say the pound is still vulnerable. I would say in general that the mood has turned a bit sour in markets, and that also is negative for the pound and good for the yen. Asking your question about pound yen, 162.30 at the moment. Also here we fell, and what the rise in pound yen could be seen as a correction. I still see more room to the downside. Again, the biggest event for the pound is the jobs report. Of course, if we have zero surprises over there, the focus will shift to other events. But yesterday we've seen that the jobs report, the inflation report was weak. The impact was minimal at the beginning, but then we had a much bigger impact as the mood soured. Okay, 160 to 163.80, I would say, is the current range. Further resistance 166. Okay. Another question. I think the Fed minutes will remind investors how low the chances are for rate hike from the Fed next month. Surely this will mean a decline in the dollar today. Do you agree? Well, if the Fed, I don't know exactly what they're going to say. If they'll remind investors about how low the chances are for rate hike in March, only in March, it's something we already know. Okay, it's 96% against the rate hike according to bond markets, and if you ask also economists, the most hawkish ones are talking about June. So if it's only about March, it will not be a surprise and will not hurt the dollar. If they paint a very worried picture and hint that and even talk about negative rates like Yellen talked, Yellen was asked a question, she didn't initiate this talk, then of course we could see a bigger decline in the dollar. Mostly against the risk currencies, because if the Fed is ready to keep rates unchanged and even cut them, then it's good for risk assets. So yeah, if the Fed goes dovish, you could see the dollar declining more against the pounded commodity currencies than against the safe haven euro and yen. Regarding next month's rate hike, I think it's a done deal. According to markets, economists, everybody, there will be no rate hike in March. Okay, we have a press conference and fresh forecasts in March. There's still some chance, of course, if the NFP is really great, if the updated GDP report is upgraded, but it's an outside chance at the moment. So if it's just a reminder about March, it's not a big deal. If it's a gloomy picture for sort of the rest of the year, that's already, or in general, no more rate hikes or rate cuts, then it's quite a big deal. Okay. All right, euro dollar not moving too much. Usually we have bigger movements during the show because it's the market open. Well, this time euro dollar is one of the more stable currency pairs. At least perhaps we're seeing a light risk on atmosphere this morning. No, that would be an exaggeration. Oil prices are a bit higher. Commodity currencies are a bit higher, but only I would say in the last minutes. It's not so meaningful. This is the wrap up for the live market open for Wednesday, February 17th. We had a change in mood in markets. The mood has become a bit more negative. Markets don't buy the announcement about the freeze in production from Russia and from Saudi Arabia. Oil prices did fall. Stock markets in the US got stuck, and in Asia, they began falling. Okay, another thing that dampens the mood is that China devalued the yuan just a bit, but there are worries once again about China. The mood in general is worse. When the mood is worse, what do we have in markets? Stronger euro, stronger yen, more pronounced in recent days. The euro is still suffering just a bit from Draghi. So the dollar yen fell from the highs near 115. Support 113.20 to 114.25 is the current range in dollar yen. The yen is still the ultimate safe haven currency, even if the Bank of Japan intervened last week and is ready to intervene once again. The yen remains strong in times of trouble. Euro, small reaction here, currently around 111.60, much narrower range in comparison to previous days. 112 to 111.20 is the current range. Support, very strong support at 110.70. Okay, the pound already had much more volatility, suffered a huge downfall, a slight miss on inflation, compounded with previous comments by McCafferty earlier in the week. And we had a big fall, break below support at 143.65, further support at 142.30. Big event today for the pound. The jobs report, most important part of that report is the wages. The average hourly earnings, I would say including bonuses, expected to tick down from 2 to 1.9. Also note the claimant count change and the unemployment rate, but wages are the most important. Okay, below 142.30 we have 141.25 if we have a really terrible report, or 143.65 and 144.50 on the top side. Dollar CAD moving by oil prices. 138.87 remains resistance. Is support. 137.87, resistance 139.10. We already reached lower levels. Further lines 140, 137.20. Aussie dollar back to the lower range, back under 71, 71.40, some kind of resistance. 70.80, 70.40, and 70 are lines of support. Big night for Australia with the jobs report. In the past three events, it was positive. This time, we're expecting another rise of 15,000 jobs. And also the Chinese inflation report is also impactful. The Kiwi dollar is on the back foot, struggling with the previous support line of 65.80. It was hit for the fourth time this week, this time by milk prices, which disappointed. Earlier in the week, we had disappointing inflation expectations, retail sales, and a negative comment by the Prime Minister over there. Okay, other events we had yesterday, not worth mentioning. So today, the big event for the morning is the UK jobs report. Can move sterling across the board. Euro, pound yen, and you name it are expected to move. Of course, cable, mentioned that. We have lots of data from the United States, housing starts, building permits, and producer price index. They could move the market only a bit because, first of all, they could come out mixed. One figure goes up above expectations, the other below. Okay, so it could be a big mess. And also we're expecting the meeting minutes. So we have housing starts, building permits, and PPI, producer price index, at the same time. 45 minutes, industrial output, which will probably be bad. And at 7 GMT, the main event for the day, the Fed meeting minutes. On one hand, it's 3 weeks old. On the other hand, it's revised until the last moment. And again, one hand. On the other hand, we have, on the positive side, we have growing employment and recently some positive figures in the United States. The negative is, of course, the Fed likes to blame China. And of course, inflation is not going anywhere fast. If we have hawkish minutes, and I have a small bias towards hawkish minutes, it's negative for markets, good for the euro, good for the yen, bad for all the rest. If we have the Fed standing alongside markets, providing full support, then we have, of course, a rally in commodity markets, in commodity currencies. Let's see how this develops. The Fed usually, they try to make things very, very balanced, okay? And yeah, I mentioned the Australian jobs report and the Chinese inflation data. So I guess that's it for today. We have markets are in movement. Euro dollar is a bit stuck, and I don't like it. I hope we don't get stuck like we got stuck a few weeks ago. But we have other currencies on the move. The pound is a big player for today. Another thing I didn't mention in the wrap-up is the Iran-Iraq meeting over oil. Yesterday we had an agreement that markets didn't buy. Let's see if now they become a bit more convinced. The big question is Iran, which just came back online, if it will be ready to cut or freeze. I have lots of doubts, I think, and there's also not so much trust between Saudi Arabia, Iran, and Russia, and quite a few other countries over there. So should be another interesting day. We'll be here tomorrow talking about the meeting minutes, about everything about oil. I wish everybody a safe and successful trading day. And I'll see you all tomorrow. So that's it for today. Thank you and bye-bye.